All right, let's welcome the first corporate guest of the morning. Joining us is CSB Bank Management. CSB Bank reported a robust set of Q3 business update. Deposits jumped 22%. Advances climbed 26% year-on-year basis. To discuss this, we have Pralay Mondal, Managing Director and CEO at CSB Bank with us. Mr. Mondal, thank you very much indeed for joining us. A very happy new year to you from me and from my co-anchors and all of us at CNBC TV18. Well, you have, kind of lightened up or enlivened the market with very good numbers. Would you say the deposit war is over? I mean, 22% is a damn good deposit growth.
Good morning, Lata, and good morning to all your viewers and others on this panel. Yes, we had a decent quarter from a deposit as well as assets growth perspective. And to add to that, I must say that while deposit growth was marginally lower than our asset growth, but we complemented with a significant FCY borrowing, which we also did from the likes of IFC and HSBC and others. And also we are using refinance as another option for managing the liquidity. So we are well placed right now as we're talking in terms of LCR and NSFR and other ratios, which finally talks about the quality of the funding franchise which we have. We are yet to create a great deposit franchise, which we are working on through our technology and other products and services. But right now we are doing enough to manage the liquidity to kind of complement the credit growth which are happening. On your question on is the deposit kind of over, I think we are far away from that at a systemic level. We being a very small player of the overall ecosystem, it does not really reflect the real challenge that's happening in the ecosystem. So I think given the liquidity is negative for a while right now in the overall system, I think it's far over, and every bank, including us, are constantly working to see that how do we manage our liquidity and deposit growth.
Oh, in that case, would you say, therefore, the pressure on margins is not over? If maybe you can even share what is the average cost of deposits, the going rate?
So it depends on which kind of instrument we are using. I mean,
overall average.
Yeah, on an average, I think it should be somewhere close to around 7%. Some of the larger banks, of course, will be lower than that. We are somewhere around that. But in terms of margins, I think we are somewhere close to 4.3 as per last quarter. I don't see margins getting elevated at this stage. The reason being, once the rate cuts happen, if at all, sometime next year, initially the rate will get passed on to the EBLR linked loans, and deposit costs will not come down immediately. So to that extent, I think margin pressure will be on for a while. Only by the end of next financial year, I think we will start seeing some comfort on the margins level. So next 3 to 4 quarters, I think there will be margin pressure as well on the overall ecosystem as well as on our bank.
All right. Hi, Mr. Mondal. Good morning. Good to see you and Happy New Year. Looking forward to chat with you all through the course of the year. Let's get a couple of numbers going then. 4.3% was your NIMS as of the past quarter. So you're indicating you'll be able to maintain it around these levels. Could you confirm that? Point number one. Point number two is on the loan growth. You've always been telling us you'll outgrow the industry. So what kind of industry growth are you factoring in, and by how much will you outperform?
Good morning, Nigel. I think I always said we'll outpace, but this quarter I think we have done pretty well on the loan growth. We have to see how we sustain that. The systemic growth should be somewhere close to between 11 to 12%, I guess. And my past kind of a commentary was that we will be 30 to 50% faster than the system. I still hold on to that because a quarter here and there doesn't change things. But broadly, I think this year at least, we should be in line with what we are doing at this point of time. So we are pretty comfortable on that. Loan growth is not a challenge. I think the bigger challenge is how do we fund that loan growth? And that's the systemic challenge which you have. On your NIM, I think we are somewhere around 4.3. Give and take 10 basis points here and there can always happen. But broadly, I think we should be able to hold it somewhere there in my view.
Okay, all right. Give us a few more details then. The gold portion of your business continues to do well. As a percentage of the mix, I think it's at around 45%. it'll continue to hold here going by the kind of growth you're seeing out there. But you've told us in the past that many years down the line, you want to bring it down. But in the near term, should we be working with it holding as a percentage at around that 45%? And will your CD ratio come down to around 80% overall?
Nigel, in our last conversation also, I said that gold will hold at reasonably high level for another 2 years because the entire technology implementation which you are doing this year will help us start building the liability franchise, and the asset franchise on the retail side will follow that, because we don't believe going on and getting business in a slightly challenging market at this point of time on the retail side. So we believe that we have to build up the customer franchise first and then build it. So from that perspective, gold will remain very important for us. This quarter also, we have grown the gold by around 36% in terms of year-on-year growth. The retail growth has been around 33 odd percent, and SME growth has been 28%. Wholesale, we have not grown, as I said before that. Wholesale, we have grown by 4% year-on-year, but I believe that Q4 onward, which I told in my last commentary as well, Q4 onwards, we'll start seeing the growth on the wholesale side. Reason being, we were running off some of the portfolio which we didn't like on our wholesale side. So from that perspective, including the DA portfolio which we had. So from that perspective, I think our asset growth will sustain. On the mix, FY27 onwards, we will see retail starting to jump up. Wholesale will start to jump up as a mix from next year onwards, next FY. And hence, as a proportion, gold may either hold or come down marginally in the next 2 years. But significant mix change will start happening from FY26 onwards.
Okay, Mr. Mondal, I think we are not addressing the elephant in the room. Several Reserve Bank reports and experts are pointing out that the rise in gold loans, like microfinance, is actually signifying pain at the bottom of the pyramid. They don't have anything. That's why they are pledging the gold to borrow. And one also saw, therefore, rising defaults. My question to you twofold. Are you noticing problem with gold loan borrowers unable to pay? The fact that you have collateral is another matter, but are defaults rising? And is this an indication of pain?
Lata, there is a significant difference between businesses like unsecured microfinance and gold. If it's operational, if it's run well, I don't see too much of a default you will have in gold, unless, of course, suddenly there is a 20-30% fall in gold loan prices, which we don't see at this point of time. But yes, there are compliance things which one needs to focus on. There was a 30th September circular from RBI, which we have confirmed to compliance, and we have to see operationally how we manage those kind of things. So it's not so much of a credit cost. I mean, SMA goes up and then eventually doesn't translate into NPA in gold loan businesses.
But you're not noticing higher defaults, are you?
No, not at all. And let me tell you, just one common perception that gold loan is bottom of the pyramid is not always correct, because there are 3 segments in gold loan, and one part of that is also SME, who use it as a short-term working capital, and those ticket sizes are slightly larger. And obviously, the rates are lower than if they go for unsecured. So from that perspective, there are various kind of banks and institutions and NBFCs addresses different segments. Our gold loan rates are somewhere below 12%. So obviously, we are not looking at the bottom of the pyramid. And our average ticket size is also more than 1 lakh, significantly more than 1 lakh. So from that perspective, I think we have not seen. In fact, the lowest credit cost in our entire portfolio is also gold loan at this point of time.
Take that on board. Thanks a lot, Mr. Mondal, for joining in. Post your Q3 numbers. We re-invite you on the show, and we'll get a few more details out of you for the remainder of this calendar as well. But wish you well, and we'll be in touch.
Thank you, Nigel. Thank you for having me.